Stocks got absolutely spanked after a 3-day rally. I told you guys I thought this rally would be short-lived, and I was expecting it to be somewhere between the 200-day and the 100-day moving average. We got just above the 200-day moving average before falling back down and actually having a minus 2% day last Friday as of the time of this recording. So in this video, I'm going to be giving you my up-to-date take on the market, where I think the market is going to be headed. I've been helping you navigate the market this entire year through this sea of volatility, helping you manage your stocks, options, etc. I will be giving you some plays towards the end of the video as well, because I do think that there is a really juicy play on volatility. If you've been a fan of this channel, you likely know what I'm talking about. I'm also going to be telling you what to watch out for this week, from the tariff showdown that's to come on April 2nd to the unemployment report that we have on Friday and everything in between. If you care about your portfolio and you care about your money, you definitely want to stick around. Let's get right into it. So as I told you guys, I thought that we would get a short-term rally, but it would be nothing more than a short-term rally, and it would end somewhere between the 200-day and the 100-day. It's very hard when you're dealing with such a short range to tell you exactly where it's going to end, but I thought it would end somewhere in this range here, and we just crossed above the 200-day before then falling and having a 2% day on Friday. If you guys recall, back when I was telling you guys about the oversold RSI, sometime in the beginning of March, I said that I do think, even though this is an oversold RSI, that we would hit a new low, only because this is something that we've done before. Every time the RSI was oversold, it seemed to be a false signal before we got another low. This is a characteristic that is very prevalent in the S&P 500. I also shared this with you on March 17th. I said that if you take a look here, when we have back-to-back 90% upside days, meaning 90% of the S&P 500 stocks are advancing, those days are very rare. Having back-to-back of those days is also very rare. And we achieved that on March 17th. However, if you look at this, a week later, typically, we are down an average of minus 2%. And almost every time later, 2 weeks later, we are down an average of minus 1%. You can see all of the times that this ended negative 2 weeks later, which 2 weeks after that March 17th date is Monday coming up, Monday, March 31st. Now, as time goes along, this tends to get better. And, if you go out a year later, you could see that only one time were we red 1 year later, with almost every other time being massively green, not just green. Now, one thing, if I pull up the 21 EMA here, one thing that is not good is that the 21 EMA crossed below the 200 SMA, right? The 200 simple moving average. So the 21 EMA is the white, SMA is the green. This right here has not been a good sign for the market. So if we look at previous corrections, so if you look at what happened last summer in August, we didn't even come close, obviously, to touching that. If you look at every other time that the 21 EMA crossed below the 200 SMA, you could see that we actually fell into what we call a deep correction at least. So a correction is minus 10% or more. A deep correction is more than minus 10% up to minus 20%, usually minus 15 to minus 20%. So if you look back here in February 2022, this actually gave a false signal of an interim bottom right when the 21 EMA crossed the 200 MA. And we actually did have a nice month of rallying before then falling to a really violent bear market. If we go back to 2020, this obviously crossed and we hit a bottom. This was during the pandemic, so it was a V-shaped correction. We printed $5 trillion right here. It wasn't exactly on this date, but we did start printing money here, and that led to a very violent V-shaped bounce. If you look in 2018, this is what is really interesting to me, because 2018 is when the tariffs uncertainty started back then during the first Trump administration. Now, what's really interesting is when we first hit a correction in the beginning of 2018, the 21 EMA did not cross below the 200 EMA, the 200 MA. And this is what led to a nice summer rally. It looked like all the pain was over, and we actually surged to a new high during the summer. And then in September, we had another drop. And then once the 21 EMA crossed below the 200 MA, this led to an almost bear market. It was minus 19 point something percent. So not quite minus 20%. Almost the bear market, not quite there yet. The point is here, guys, every time the 21 EMA crossed below the 200 SMA, this does not bode well for the market. And every time in recent memory, it has not led to the end of the correction. And the correction went from minus 10%, as we've seen here. The 300 MA, the blue line, was minus 10% on the S&P 500 to a deeper, at least minus 15% correction. Now, if we take a look at the expected move for the S&P 500, you can see here April 4th expiration of SPX options. You can see here that it is plus or minus 144. That means on the upside, around 57.24 for the S&P 500 on the upside. And the expected move for the downside is around 54.36, if my math is correct off the top of my head, is around 54.36. So this is the range for the S&P 500, which is quite a big range. Now, that downside target, 54.36, if we measure it from the top, let's see what that puts us under in terms of correction. It's only about a minus 12% correction. If we map out 15%, right, let's just do some very rudimentary technical analysis here. You get to about that low that we saw on August 5th. To me, there is a lot of confluence here, right? You do have these equal lows from May. You have that August 5th low, which is right around here, right? So this range to me is, I do think we will see more downside. And I do think that eventually this area right here is where I would be targeting for an interim bottom if we get a continuation lower. Now, you guys know, and I've been telling you on this channel, that we've seen this in 2018, even in 2022. It's not going to be as elegant as a V-shaped up or an upside down V-shaped down. It could really be like this, right? People don't want to hear this because it promotes uncertainty, but that's really the nature of these types of markets when we have a Fed that hasn't yet made a decision, when we're still battling a little bit with inflation, even though I think most of the inflation story, at least as it relates to the market, is over. We're still battling high yields. We're still dealing with an administration that is trying really hard to bring yields down so that it lowers their interest payment. We're dealing with spending cuts. We're dealing with employment cuts, and the federal government is the biggest employer in the entire country. It's very, very difficult to have these definitive bounces up where we make all-time highs, or a definitive straight shot down where, you know, we end a bottom and finally can see an end to this uncertainty, and hopefully a market that continues to make a healthy market that continues to make all-time highs after all-time highs. It's not going to be that clean. Please don't ever quote me as saying it's going to be that clean, because I know how these things play out. We are likely going to get a lower low than this low here, but that could very well induce a bounce. It could induce chop. It could induce a little bit more rallying. We will talk about some of the data markers to expect next week, as well as what the tariffs could yield, right? Imagine Trump comes out and says, we've worked it out with the countries, Mexico and Canada. We don't really have to go into a deep trade war. We can actually negotiate our way through this. You might see some optimism in the market, right? So these things are not going to be as black and white. Just know that this right here, because of where we are at technically, this is a good eventual target to eye right here around these lows. Now, before I tell you what some of my buy targets are, what some of my trades are, I just want to get into what is on the docket, what is on the calendar coming up next week. So we do have JOLTS job. It's a big jobs week. Okay, let's just say that. JOLTS job openings on Tuesday. We do have ADP non-farm employment change. These are all pretty minor in relation to the ever so present unemployment rate, right? The unemployment rate is going to be the one that the market is going to be monitoring, because we have not yet seen a reflection of the job cuts that the government has been doing. We have not yet seen that reflected in the unemployment rate. And yes, all of these jobs, all of these jobs data matter, and they are going to move the needle on those specific days. But really, the unemployment rate is what's going to have sticking power. If the unemployment rate starts rising, and it starts rising significantly above these estimates of 4.1%, that is going to compel the Fed to cut come May 7th. Right now, there's only a 16% chance that they cut, but I guarantee you, if this comes in higher than expected, you're going to see this 16% chance rise precipitously. We already saw the Fed cut back on its quantitative tightening by saying that it's only going to roll $5 billion of assets per month off their balance sheet instead of 25 billion. The next step could be cutting that last 5 billion to no QT at all, followed by a potential rate cut. Really depends on what this data yields here. And then obviously April 2nd, look out for the clarity on the Trump tariffs. Right now, nobody knows what's going to happen on April 2nd. And here we have Trump basically reiterating that he's not looking at the stock market. Listen to this question.
And on these auto tariffs, we saw obviously the NASDAQ 100 go down 2% at close, S&P 500 down 1%. What are you concerned about that market reaction?
Today?
Yes, sir.
I didn't say that. I want to see the jobs. I want to see that'll all take care of itself. That could take care of itself in 1 day, 2 days, or 1 week.
So again, reiterating that their priority is not the stock market, right? That they are focused on cutting jobs. They are focused on cutting spending. They are focused on bringing yields down. That is what the Trump administration is focused on. However, I do think that looking at this, there is a point at which the market starts dropping that the Trump administration will try to soften it, at least at least very temporarily, right? We've seen this when the market has dropped significantly. Some of these green days here have been when the Trump administration has softened their language. The only problem is, when they soften their language, what tends to happen to yields, if we take a look at the 10-year yield, what tends to happen is that yields also start to rise. So then they have to reiterate a harsh stance on spending cuts, on job cuts. They have to maintain a harsh stance on that for yields to drop once again. You can see that not only did the stock market drop on Friday, but yields did as well. So they cannot soften the language too much. And this is part of the reason why I was telling you guys I thought that any pump in the stock market would actually be temporary and that we would see new lows. All right, so let's talk about some trades and some buys here. So what am I going to do with regards to the indices? I told you guys that I never miss the opportunity to buy SPY or NASDAQ at minus 10%. I'm not going to touch this until we hit the August 5th low. What I mean by that is I'm not going to touch it again, right? I'm a very big believer in spacing out your buys. You do not want to buy too often because you're not making a dent in your cost basis. The point is to make a dent in your cost basis for things that you want to own so that when the market rebounds, you can be in a position where you are profiting immediately. If you don't cut into your cost basis significantly, then you are obviously going to be buying higher than you anticipate. And if the market does suffer more of a drawdown, if it does rebound, well, your buy was up here and it wasn't closer to here. So my next buy on the S&P 500 will be close to that August 5th bottom if we get there. Remember, I'm not saying it's going to be a straight shot down. We could make a new low here. We could bounce because the tariff uncertainty is behind us, and then make another run down. That is very much in the cards here. This is not going to be an easy road to read, regardless of how easy you want it to be. I told you guys Google that my next target was that 140-ish range, right? And it looks like we are going to get there with all these scares about the antitrust. Once again, you can see Google here has a support level there. It is not out of the realm of possibility to get to this support level and also finally fill this gap. I told you I'm not a believer in AMD. I got some hate for this one, especially as AMD did pop above this trend line. And I said that I need AMD to break market structure and retest that market structure break. This right here is not a break of market structure. It broke the trend line. It didn't break market structure. I needed it to break above this and retest this. Right here, AMD still looks weak to me. No change in my AMD stance. If there is an optimal short, I will take it. I don't see one here just yet. Now, I do want to talk about semis as I pull up NVIDIA's chart. This right here is the reason that I initially, a while ago, I think back in February, thought that, hey guys, we are in a lot of danger here. Let me explain myself. So if you take a look at my tweet from February 28th, by the way, if you're not following me on X, I don't know what you're doing. I put out the most free trading and finance content on X, more than anybody else you follow. Maybe that's an exaggeration, but I will humbly say that I'm one of the more useful follows on X, okay? But on February 28th, I said, if SOXX, which is basically the ETF that tracks the chip stocks, or the index that tracks the chip stocks, unwinds, this could be the catalyst for the next recession. Everyone's looking at housing, unemployment, inflation, etc. So you guys know that a huge part of the reason that the market rallied the last 2 years was because of AI and chip stocks. That is the reason that the S&P 500 had back-to-back 20 plus years. You also those charts with the correlation between the S&P 500 and the Mag 7. And there were even charts between the S&P 500 and NVIDIA. And when NVIDIA went up, the S&P went up and vice versa. And I was noticing how coiled SOXX was appearing towards the end of February. And I said that this looks very similar to what we saw in 2022. And we are going to break out violently out of that coiling, and that will likely be a downside move. And if we keep dropping on SOXX, that is what is going to help push the next market crash and thereby the next recession, is this unwinding of the chip stocks. Now, as I told you guys before, it's not that I'm bearish on chips for the future, but all of these new emerging technologies go through boom and bust cycles. We go through a hyper spending phase, and then the market has to sit back and be like, how are you guys going to make money from all of this money that you spent? Great. We have hyperscalers. You guys are investing in LLMs, open source, closed source, etc. Now make money from it. We love that you're spending money on NVIDIA chips. We love that you're trying to build layers on top of that. We love that you're building out server racks. We love that you're building out data centers. Now, can you make some money from it, right? And this wait and see obviously puts a pause on momentum. And that pause can obviously build negative momentum as these stocks correct, which is a very natural correction. But unfortunately, a lot of the reason that the S&P 500 was up the last 2 years is because of chips and AI. And if this starts unwinding, that will bring the market down. And unfortunately, since I made this post back on February 28th, where we were still coiling, if you see here, this is the outcome. We are now dropping below that August 5th low. So this is sort of the canary in the coal mine here, in my opinion. Now, I was hoping that we got a little bit of a retracement up to help me take a short, but this has been a tough market to short for a broad amount of time, because even if you look at the S&P 500, we haven't really gotten a point at which the market is retracing up for an optimal short. It is just straight death. Now, some of you I saw online, some of you went short at the 200 MA. That's a pretty good strategy because you could set a tight stop limit above that, and a 200 MA rejection does make sense. We know that the market, especially the S&P 500, does respond to these major moving averages, especially since the 21 MA was right there. And you could have done that and it would have paid off really well. I didn't do that for the S&P 500, but I'm recognizing it as an optimal play if you did take it. Now, there's been a lot of negativity, and just because the 21 EMA crossed below the 200 MA, I showed you this before, even in one of the worst bear markets in recent memory. When this has happened, this has actually marked the bottom, and we put in a new low below the correction low. This is something very similar that can happen here, where we put in a new low below the most recent low at the 300 MA, which we have here. If you look at this, that's the low at the 300 MA. That is what categorize the correction for the S&P 500, right? So we will likely put in a new low below that, but that can also give us a rally thereafter, especially if the news regarding the tariffs is going to be perceived as positive. We know a lot is priced in, okay? We cannot ignore that a lot of bad news from the tariffs is priced in, a lot of uncertainty is priced in. So if Trump gives us certainty and everyone's looking at this as like D-Day, we can certainly see a counter rally once all of the stuff is priced in, especially if it's not as bad as expected. And if the unemployment rate doesn't go up significantly, if you couple that with the fact that the tariff news is mostly behind us for now, that can cause a short-term rally still in the S&P 500, even if we put in a new low. So I'm not discounting that. But my base case overall, whether it happens quickly, whether we make a new low, see a rally, and then fall again, my base case is still lower. I'm still expecting lower on the year and would not be surprised to hit that August 5th low. Now, one other thing that I'm thinking about doing is shorting UVIXY before April 2nd. So April 2nd is a Wednesday. I'm thinking about, you can see here all of these UVIXY calls, how much they went up because volatility went up, right? And when I short volatility, I like to use UVIXY because it's a leveraged ETF. When I buy volatility, I don't like to use UVIXY because I would much rather play either the VIX futures or the VIX calls themselves. So I would look at maybe the April 17th or the April 25th, depending which one has more volume. It looks like April 17th has way more open interest than April 25th. And I would likely buy the at-the-money puts, depending on what they are on April 1st. I would likely buy the at-the-money puts on UVIXY, betting that volatility is going to decline after the Trump tariffs are announced, whether it's because most of the bad news and uncertainty is behind us or whether there's actual good news on that day. I will likely look to short volatility. This, by the way, is Public here. Shout out to Public. The cool thing about Public, one of the cool things, many cool things that I like, is that you get order flow rebates. You actually get a cut of the order flow. So Robinhood takes all of the order flow. That's how they make money off you. Public shares the order flow with you. So you actually get rebates when you trade. This is what I use for my stocks and options trades. And then you also have a bond account, which right now is paying almost 7% yield. And it tells you exactly which bonds they are participating in. You can also buy treasuries directly from the app for a lower risk-free yield. One other thing, lastly, that I'm watching is Tesla. So I made a prediction to you guys, and I said that there will come a time when Elon Musk will step down from Doge, where there's just going to be too much noise from the board of his company. It is a public company. He can't just do what he wants. He has to answer to a board, the shareholders, the investors, etc. But there will be some noise from the board, and they will say, dude, you have to come back and run your company. Whatever it is, whatever your politics are, whatever it is that you think you're doing with the government, you have to come back and run this company or step down. And we are now getting news that Elon Musk told Fox News he will step down from Doge in May after achieving most of the work needed to cut the deficit by $1 trillion. So this was my prediction here, and I think that this is going to be good news for Tesla if there is an appearance that he's coming back to work in order to launch full self-driving and robotaxi. I think Tesla could see some benefit from that. You guys know that I bought Tesla in the 220s. It finally hit that range. Certainly could see lower price action. There is an ugly head and shoulders looking thing that could happen here. If the market sees an overall bounce from the tariffs being behind us and the fact that, you know, we created a new low below the 300-day moving average that I showed you before, Tesla could be a beneficiary from that. There could be a bounce off this level. I'm undecided yet here on how I'm going to play this. I'm going to obviously let the markets open on Monday and Tuesday, monitor the price action, and see if there is a potential bounce off this level here for Tesla. Anyway, traders, quick little video for you guys. Again, I'm trying to keep you as up to date as possible throughout this whole ordeal. I've received hundreds and hundreds of comments from people saying that I've helped them to gain more of a level head, not panic as much, be able to step back, be able to make decisions in a much more calm manner. And I'm really happy to hear that, because at the end of the day, day, that is all I'm here for. I do these videos for you guys. There's nothing that comes out of my mouth that I don't wholeheartedly believe in based on the analysis that I'm looking at. And I only will analyze the market as much as I could based on the information available to me, and I try to be up to date with that analysis. That is it. Anyway, if you want to trade live with me every day and you want access to all of my trades in real time, link is in the description below. Sign up, come trade with me live every single day at Market Open, where I go through all of the tickers that I'm looking at and give you my pre-market analysis, as well as take futures day trades, option swing trades, etc. We do it all. Let me know in the comment section below. Do you think that we have a lot more downside? Do you think that we're closer to a bottom? Do you think we make new highs in the very short term? Would love to hear from you. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace. Now, as I mentioned before, I've been using Public for my investing as well as my option swing trades. It's a regulated platform based here on the US. Now, we talked about commission-free trading and earning rebates for your stock and ETF options contracts trades, but they make it really easy to invest in bonds. It's not cumbersome. They actually have a bond account right now that pays 7%, giving you access to a portfolio of high yield and investment grade bonds. And if that's not enough, they have this AI assistant called Alpha. This is probably one of my favorite things on the app here. So I can ask it simple questions, right? Like, what is Tesla's free cash flows? And it tells me here that Tesla's free cash flow is reported at 2.742 billion, which represents a significant increase of 222.97% from previous figures. But I can ask it more complex questions like, compare NVIDIA and AMD. And it provides me a comparative analysis between NVIDIA and AMD, going over its financials, its revenue, net income, EBITDA, free cash flow, gross profit margin, operating income, cash and equivalents, etc., etc. So it's very easy for you to get answers to questions before you make your investing and trading decisions. Use the link in the description below and get yourself a Public account today.